Welcome back to Your Average Investor. We're going to go over a few interesting earning plays for this upcoming week, as well as levels to be watching on the S&P 500, as the June FOMC meeting is about 10 days away. Now, if you haven't already, hit that subscribe button to support this channel. First up for the week is CrowdStrike. These guys report Tuesday afternoon, and it will be interesting to see if we have a continued trend of tech companies dropping on earnings, similar to how CRM and Dell did this last week, each of them dropping about 20% before recovering slightly. Now, CrowdStrike, they're in an interesting position because they've already sold off just a little bit the last couple days, probably in sympathy with Dell and with CRM. People thinking, you know what, these earnings are going to be similar. Let's just get out now and not expect this to come and pop all-time highs like NVIDIA or A&F or something like that. Now, that being said, an interesting level to watch will be this long-term trend line here. You can see this green line. If it were to continue extending, it would be about the $250 range. And this has been an incredible volume-weighted average anchor catch for quite some time. You can see catch and go 1, 2, 3, and on and on and on until eventually it got so high up that a new catch and go was established here. That is possibly holding a support, but if that breaks through, I would say that our next target is somewhere around this $250 range on CrowdStrike. That would be an interesting play to the downside pre-earnings. I probably wouldn't play before the earnings report. What I would do is just like the others is wait till the news comes out, see if you have a pop or a retreat, and then play the follow-on. If it goes up, follow it up and have a tight trailing stop. If it moves down, same thing to the downside. As always, this is not investment advice, simply my own observations and thoughts on the matter. Next up, we have Dollar Tree. Dollar Tree reports Wednesday morning, and they're in a pretty interesting place. These trend lines go all the way back to several years ago. They have a very strong resistance here, about 160, a little bit under 160, and a couple of interesting support zones at 122 and 117, which recently it broke below, and it's trying to reclaim right now. In fact, let me move this out to the 10-year chart so you can see what I'm looking at here. If this doesn't reclaim, the next big support is down here around $82 per share. And you might say there's another mini support here just around $100 per share, right in the middle of where all of this chop happened. So I'll add one more line here for myself, right about $100 a share. And you can see that acted okay as support and resistance through this period back here. Could see the same. So I wouldn't be surprised on earnings to see Dollar Tree drop down to around $100 if we continue to have a trend of sell-offs on earning reports. Now, other than Dollar Tree, the only other really exciting earnings for Wednesday is LULU. LULU reports Wednesday evening, and you can see they're also sitting on a very interesting multi-year trend line here at the $300 mark. If this trend breaks, then it would be very easy, I think, to see lows of about 250, supported by the pre-COVID all-time high. So maybe this would be our next area to watch. If it moves back up, I would be surprised if it moved higher than about $375 per share. Definitely don't think Lulu's going to be going to all-time highs on an earnings report. They could surprise, but that'd be the range that I'd be looking at playing. Sitting right in the middle of it, the play doesn't feel super good for earnings, but if you can find the right position to play either way or play a continuation after earnings, these are the levels I would be watching for above and below. Next up is Thursday. We're going to skip Thursday morning and go to Thursday evening. DocuSign reports Thursday evening. Similar to Lulu, we're looking at some long-term trend lines that go all the way back here to 2018. And you can see, other than this large mountain of, COVID, post-COVID mania around DocuSign, they really have struggled to regain any kind of semblance of price appreciation. And that makes sense to me. They pulled forward a lot of their earnings and customers in the COVID era, and basically everybody who wants to be using DocuSign is using DocuSign right now. There's not a huge moat around what they do. It's pretty easy. It's just PDF signature software. And I know they're trying to expand to other things, but it wouldn't actually surprise me to see this drop on earnings, just because I don't think the company has all that much exciting new stuff in the pipeline, and there's no reason to expect that it's going to all of a sudden do better than like Dell or CRM, when it's a fairly niche product. So I'm going to possibly take some sort of short position on DocuSign with a very short trailing stop and look to play this back down to the $50 range, if not down into the $40 range. The last earnings report is a big one. Whoops, it's not dig, it's big. Big Lots is reporting Thursday morning, and Big Lots has been just absolutely wild and beaten down. So I'm actually going to switch this time frame real quick to the monthly. We're going to go monthly max available so you can see what this looks like. Here we have Big Lots IPO back in 2006, and it cruised along for a couple of years before making some nice gains. We're going to look pre-COVID here, from $17 a share all the way up to $63 a share before a large sell-off, stopping right around the $10 area and then marching on up to $73 a share. This is the COVID sell-off here, right? And then $73 a share, followed by another huge sell-off all the way down to massive all-time lows of $3.13, currently sitting at just under $3.50 per share. Very interesting to be watching this, especially considering recently, if you look at their earnings reports, they've been hemorrhaging money. They've been bleeding money a lot. And this is what's causing the share price to be down so much. I'm going to pull open FinViz real quick so we can take a look at that. And I'll just remind you what we're looking at with Big Lots. So FinViz here is going to show us just a little basic snapshot overview. You can see that they've got cash per share of about $1.57. Times that by 29 million shares in their float, so they're sitting on maybe this, I'm guessing this might not be accurate actually. 29 million float times this, that means they only have like 45 million bucks. And if they are losing $500 million a year, they'd be out of cash already. So it'll be interesting to see what they report these are the numbers I would watch in their earnings. This is actually why I'm nervous to play it before earnings. I want to get in after earnings, depending on the earnings report. But their cash position is quite low, although their book value per share is significantly higher if they were to liquidate inventory and etc. Although if you get into a liquidation scenario, you're probably not going to get $9.73 per share book value. It'll be a little bit less. But they're losing $500 million a year. And so unless they have a dramatic cost reduction in place, in addition to increasing their top line, then this is a very spooky position to be in as an investor, because likely what happens is they issue an at-the-market offering, which drives the price down significantly, maybe an at-the-market offering in addition to a reverse stock split or something like that. And I don't see them being able to raise that much cash off of it for that to be worth it to them either. So tough position to be in. I'll be very curious to see what happens on earnings. If they have a good earnings report, magnificent upside potential here. I wouldn't be surprised if they had an earnings beat or had like a surprise where all of a sudden it's like, hey, we had a profitable quarter. I would not be surprised to see this jump immediately to $10, maybe $15 per share as people wake up and go, oh, hang on, maybe this thing is pretty undervalued. Like, we should get in on this. This was one that Michael Burry, the famous investor from The Big Short, was also in for a little while. He bought and then sold his position relatively quickly, so he's no longer in this right now. Let's move back to the 2-day, 1 day, 2-year chart. So I believe Michael Burry bought in sometime back here, and then he sold sometime up here. So maybe he made a little money, maybe he lost a little money, but ultimately he decided to exit his position. Maybe he's been filling the position back up. We don't know. But it will be very interesting to see what happens in this next earnings report. I'll be digging into that earnings report, or their past one again, before this Thursday to see if I want to risk buying in before Thursday morning's reporting. Now, the only other thing we're going to go over right now is the challenge account and then just overall S&P 500 where we're at. Challenge account still has the Jumia cash secured puts. Let me just pop over to that chart real quick. No big movement there on Friday, and so we didn't have an opportunity to exit at $10 per contract, which I would have liked. Had a little bit of a sell-off and then just gained right back up. I would like to see this pop up solidly above this trend line, above this resistance level come Monday or Tuesday, and then hopefully exit this position at between $5 and $10 per contract. So I've collected 90% or more of the value. And then what I'd like to do is switch the challenge account into SoFi and potentially Big Lots. There are some others that I'm looking at in addition to those. Let's see here. What else I've been watching? I've been watching Riot. Riot would be an interesting one. It just recently dipped below 10. However, it would require basically the entire account on Riot. It does have excellent premium, though. If you look here, I could snag 100 shares and sell a covered call for about $86, or I could go cash secured puts and get like 50 bucks on a put 9. So either one of those, excellent. This put 9 giving me about a 5% gain, 6% gain, and this cash secured or this covered call giving me nearly 10 or 11% gain. Other than that, AMC kind of looks interesting. It's dipped down pretty dang far and looks like it could be bouncing off of this trend line of $4. If it dips down and holds, I'd like to see it. The problem is I'd like to see this base for several more days before buying in, so we don't have something like this where it slips down real suddenly. And if it does so, I think that there's a lot of premium to be had here as well. You can see this premium is just absolutely nuts. For 430 bucks, you can get nearly $60 of premium here. So you're talking about a 15% protection on the downside in case it moves down. If I'm going cash secured puts, same thing here. Look at this, we're at 4.3. So it goes down to 4, maybe I get $50 there. It protects me all the way down to 3.5. So these cash secured puts are looking really interesting to me. And that might be where I choose to put the money in the challenge account next. The last one that I'm looking at is DDD, 3D Systems. These guys are reporting earnings soon, but they haven't put an official date out yet. The only thing I don't like about them is there's not great premium on either the puts or the calls. However, it does look interesting for a bottom scraper play. I'll probably keep this one off, though, just because the premium doesn't exist on the contracts. The last one, of course, is Domo. We looked at Domo before earnings. They dropped massively on earnings, immediately had that bought back up before falling again and looking like maybe it's going to catch up a little bit. The 6.5 area is very interesting, but similar to the what was I just looking at? I don't remember, but premium's not really there, right? Cash secured puts kind of suck. Covered calls, they're not bad. The covered calls aren't bad. You know, if you did a call 7, that wouldn't be terrible. So, considering Domo, considering some of these others, back to SPY though. We'll look at these trend lines, then we'll call it a night. Here's the big trend for SPY, right? You've got just this little channel that's been forming. It broke below for just a little bit and reclaimed that channel very quickly. The upward side, as you can see, has been respecting. It fell a little bit before the top of this channel. Maybe we're zooming up there. My thinking on the S&P 500 and the market overall is based on the last year's gains plus this year's gains so far. I would be shocked if we have much more upside above 540. What I think is going to happen, because it's an election year, is we're just going to be range bound between 500 and 540 for the next 6 months. I think maybe we see one more pop to all-time highs around 540, maybe a little bit higher, right, 545, 550, something like that, and then see a big sell-off back down to the 500 range, and we just bounce up and down from there. That's my thinking on the S&P 500. Could be totally wrong there, but it's an election year. People get nervous on election years, and by people I mean hedge funds, banks, institutions, etc. They're the ones that control the price of the stock market, not us. Anyway, thanks for tuning in. Hope you guys have a wonderful rest of your weekend. I'll catch you tomorrow.